Welcome to the My Retirement Clarity Podcast, where our goal is simple, to help you close the gap between what you know and what you implement. The team at Perkins Wealth Management does this by helping good people make great decisions so they can enjoy an amazing retirement. And now, here's your host and financial advisor, Lee Perkins.
Hello and welcome into the My Retirement Clarity Podcast, where we discuss a lot of different financial topics that are relevant to our listeners. I'm Lee Perkins, your host and trusted financial advisor. And today we're going to be tackling a topic that's on everybody's mind, and which is recent market volatility, of course, that's been triggered by the Trump tariffs. So that is a mouthful. So we're going to discuss what these tariffs mean, their immediate impact on the markets, and of course, some of the underlying causes of the market reactions, and most importantly, why it's important for you to stay calm and maintain a long-term focus. So as we all know, global trade policies have really been a very hot topic as of late, and the introduction of these tariffs by the Trump administration has created a lot of buzz and a lot of stir in the financial markets. So I know you've probably seen news headlines just highlighting the fluctuations in stock prices and all the volatility that we're seeing in the market. But what exactly are these tariffs? Well, in simple terms, kind of plain English, these are taxes imposed on imported goods. And so the goal is often to protect domestic industries by making foreign products a little more expensive. And so while this on the surface might sound like a good idea to support local businesses, it can lead to higher prices for consumers and then maybe even retaliatory measures from other countries, which contribute to market uncertainty. And so we've seen this a lot recently, and of course we've seen these tariffs imposed on a variety of different goods, from steel and aluminum, electronics, and even agricultural products. And so these, of course, impact various sectors way differently than others. And some industries are going to face higher input cost, and others are going to benefit from reduced competition. And so, of course, this is what adds to the overall uncertainty in the stock market. So anytime new tariffs are announced, markets sort of react swiftly and often negatively. Well, why is this? Well, it's because people generally don't like uncertainty. Investors don't like uncertainty. And so tariffs can lead to reduced corporate profits, sometimes higher consumer prices, and potential trade wars. And all these things create a less predictable economic environment. And so for the major indexes, the ones we see on the news, like the Dow and the S&P 500, these indexes or indices tend to reflect this volatility on a daily basis. So, for example, you might see pretty sharp drops in stock prices of companies that rely heavily on imported material. Conversely, domestic producers might experience some short-term gains because simply their competition decreases. So we saw this a few weeks ago with some huge swings down and then some huge swings up just a few days later, and that cycle has sort of repeated itself a couple of different times. And I don't know that we're out of the woods yet, but I think it's important to understand that these reactions by investors are often sort of knee-jerk responses to perceived economic threats. And so while the market's reaction is very visible to everybody, we see it every day and hear it on the news, it doesn't always align with what the long-term economic fundamentals are telling us. But it is important to know that the market's reaction, how it's going right now to these tariffs, is not just about the tariffs themselves. It's about how we as investors feel and some other broader economic factors. And so I've heard some talk, and people are a little bit concerned about a couple of things. Corporate earnings, of course, is one thing. And I think global trade relations is also in the spotlight. At this point, it seems China is one of the main issues that we are dealing with as a country. And then, of course, all the supply chain disruptions, and we've seen some of this already. So, for example, a company that imports its parts to assemble its products here in the U.S. is probably going to see some increase in cost in those pieces or those components. And so that could create some reduced profit margins and lead to lower stock prices. And so to me, this is why it's important during periods like this and what seems like market chaos. It's really important to keep a long-term perspective. Historically, despite a bunch of different ups and downs, the markets tend to recover and they grow over time. And so this is why making impulsive decisions based on short-term events, it really can hurt your financial health in the long run. And so, like we talk about on this show all the time, nobody has a working crystal ball. And of course, we have a crystal ball in our conference room where we meet people, and that is there as a prop and an illustration to let people know that it does not work and we cannot predict the future. So think about it like this. If you're on a long road trip and you hit a patch of bumpy roads, you're not going to abandon your car and walk. Instead, you're going to stay the course, maybe slow down a little bit, navigate through the rough patch, because eventually it's going to smooth out. So that same logic applies to investing. Hey folks, Lee Perkins here. I wanted to tell you about our brand new book called Next Phase: How to Retire in a Year or Less Without Regrets. It's all about helping you prepare for the next phase of your life, whatever that looks like for you. So, if you're ready to make the most of your next phase, or if you're already retired and aren't sure you're doing all you can to get the most out of your retirement, then you'll want a copy of this book. All you have to do is text Next Phase to 478-475-2050, and we'll send you a copy right away. You can also access additional resources and register for one of our upcoming workshops at our website, www.myretirementclarity.com. Thanks for listening. Now back to the show. Another example that I use in the office pretty frequently is the value of your home. If you got an email every day, or they put on the news every day from Zillow or whoever that showed the value of your house, if you live in what you believe is a $300,000 house and you get an email saying, well, today your house is worth $280,000, would you be tempted to run out and sell that house? Of course you wouldn't. That would be insane, but it's kind of the same thing when it comes to investing. So again, the short-term volatility that we're seeing right now, it shouldn't sabotage or sort of derail your long-term plans. And so again, it's the discipline and execution of a well-thought-out strategy that is typically going to yield the best results over time. And so I wanted to provide a little bit of perspective. So we'll just kind of take a quick trip down memory lane. We've seen things like this before, significant market disruptions in the past, whether it was the dot-com bubble, the 2008 financial crisis, or just any other geopolitical events. There's always a crazy leader threatening to do something in the country, and markets react. But every time, the markets eventually recover. And many times they often reach new highs. And so, think back to 2008 during that financial crisis that I just referenced. The S&P 500 lost nearly 57% of its value over about a year and a half, about 17 months. And those people who panicked and sold their holdings, they missed out on that recovery. But those who maintained their investments saw their portfolios recover, grow substantially as things got better, as the market rebounded. And so historical data shows us, and you can Google this, that market downturns are typically followed by periods of pretty significant recovery. So the investors who remain patient, stay invested, they're often better positioned to benefit from these recoveries. So what should you do? I was going to give you a few strategies to stay the course during times like this of this market volatility. So here's a couple things for you to think about. Number one, stick to your plan. Your investment strategy was designed with long-term goals in mind. If you're working with a professional financial advisory firm, now if you just willy-nilly picked stocks or your investments and don't have a reason why you did that, then that may be of a little bit concern. But if you do have a strategy, a vetted strategy, stay committed to that plan and resist the urge to make those knee-jerk reactions. The second tip is to diversify. And it's kind of sometimes seems like advisor speak, but a well-diversified portfolio can really help you manage your risk. And that's simply because you spread your investments across various asset classes. You're going to reduce the impact of a single investment's poor performance in that overall portfolio. The third one is to do regular reviews. So we meet with our clients on a systematic basis. Now, not everybody chooses to meet with us. Some people just say, hey, we're good, you handle everything. But I think it's important for you to periodically review your plan just to make sure that it still aligns with your goals, your risk tolerance, time horizon, all those kind of things. Sure, some small adjustments could be needed, but they need to be very thoughtful and strategic and not reactionary. And then the fourth one, and I think this is the best one, is ignore the noise. We live in a 24-hour news cycle, and so that the financial news can be overwhelming, especially during volatile times. Everybody's talking about it. Everybody has an opinion, and so everybody has an agenda too. But focus on your own objectives, your own goals, and remember that these short-term market movements are just noise in the grand scheme of things. So again, despite all this short-term volatility, I think it's important for you to look at the economic fundamentals. Now, you don't have to go digging through things and research it yourself, but listen to what you trust. Do your own research. Don't just listen to the news. I kind of take that back. Don't listen to the news. Do your own research and gather your own opinion, because things like the employment rate, spending, corporate earnings, when those things remain strong, it's a pretty good indicator of economic health. And so for our clients during times like this, during market instability, we're committed to stay in touch, but I'm not going to send out a market update every single day. And that's for a couple reasons. It's because, number one, things change pretty frequently. And number two, I don't want my clients worrying about this stuff because it's just noise and there's plenty of it out there. So I don't want to contribute to that. So our team, of course, we monitor things. And if we need to make adjustments to align with your long-term objectives, you can rest assured that these decisions are going to be made thoughtfully, strategically, and without emotion, because really that is what sabotages the average person. They panic and make unwise decisions. So, of course, it is normal to feel anxious during times like this, but it's crucial to just keep an open line of communication with your financial advisor. If you get too nervous about things, call them, let them know. So let me circle back around to diversification. It continues to be one of the most effective tools for managing risk because, like I said earlier, you spread your investments across several asset classes, and this is going to impact or reduce the impact of any one stock's performance on that overall portfolio. So it's going to provide some stability when things are choppy like it is right now. Of course, it helps act as a little bit of a buffer for you against the volatility. So while one company may not be doing well, or one fund or ETF or whatever it is, another one is probably going to be doing better. So this is going to balance that overall impact. And so this is really one of the reasons that we use the illustration in our office, or the analogy of a financial house that's got 3 levels: foundation, walls, and roof. And if you've listened to this show for any period of time, you've heard me talk about that. Money in each level of this house, they all have varying levels of degrees and risk, and that's by design. The money that's in the roof, that's got a job. And the money that's in the foundation, that's got a job too. So again, investing can be completely emotional, especially during times like this, but just separate your emotion from good, solid decisions, because again, those emotions can lead you to make some decisions that aren't aligned with your long-term goals. So again, we're not trying to have the best return over the next month. We're trying to give you the best chance for long-term success. And so if you stick to a well thought out plan, even when emotions are running high right now, you're way more likely to achieve what your desired financial outcome is. So anyway, I wanted to end this episode with just a little bit of perspective. Everything that's going on right now in the news with Doge, which we haven't even talked about on this episode, the tariffs and what I call the political jockeying for position by both sides. I mean, it could be really, I guess unsettling would be a good word, but these are not unprecedented happenings. So keep that long-term focus, stick to your investment plan, stay diversified, and you'll get through this. I promise you will. So remember, the goal of investing is to build wealth over time, and it's not to avoid every single bump in the road. So stay calm, stay focused, and think long term. So anyway, I hope this was helpful. Thank you so much for tuning in to the My Retirement Clarity podcast. If you have any questions or need further guidance, you can always schedule a call with me by going to www.talkwithjlp.com, or you can call the office at 478-254-3550. We'd be happy to chat with you. So until next time, man, stay informed and stay financially smart. Take care. Y'all have a good week. Hey there, Lee Perkins here. If you're like a lot of folks, you've been listening to this podcast for a long time now. But I've got an important question for you. Have you implemented any of the ideas that we've discussed on the show? If you haven't, what are you waiting on? You know you're not getting any younger. So here's my challenge. Don't just consume the content. Our number one goal for this podcast is to help you close the gap between what you know and what you implement. So if you're ready to implement, take that first step today and visit www.talkwithjlp.com and schedule a 15-minute phone call with one of our advisors, and we'll help you close the gap between what you know and what you implement so you can enjoy the next phase of your life. Now is your time. Don't procrastinate any longer.
Investment advisory services are offered by J.L. Perkins Wealth Management, a registered investment advisor and insurance agency. Information is for illustrative purposes only and does not constitute tax, legal, or investment advice. Always consult with a qualified tax, legal, or investment professional before taking any action.